Hello number curious friends, welcome back to our channel and let's talk finance. So, plants and animals on the balance sheet? No, not a joke, that's where they belong when you run an agricultural business. And today we step into the orchard and talk about those biological assets. What is a biological asset exactly? It is as simple as that, a living plant or animal used to make money. Think apple trees, grapevines, sheep, cattle, fishing farms, timber forests. And what you harvest from that asset, apple from trees, milk from cows, wool from sheep, is called agricultural produce. Let's start with plants. Under international accounting rules, plants are split into two buckets. The first one is bearer plants. The plants which you grow to produce other things for many years, not to sell the plants themselves. Example, apple or orange trees. These are accounted for like fixed assets under property, plant and equipment rules, like our truck, and they are depreciated over their useful life. The second one is produce growing on bearer plants, the fruit that grows on the tree, like the apples. This fruit is then a biological asset which is measured at fair value less cost to sell while it is growing. We will come back to this in a bit. So, unlike a normal fixed asset, a truck or a tree, it's not measured at cost. It is measured at the so-called fair value. Also, it seems that there is no cost to acquire fruit which is growing on trees and it seemingly grows by itself. Nature is wonderful, producing something from water, energy and minerals. To a farmer, there is a cost in growing this fruit, which is watering, fertilizing, trimming, pruning, labor in the process from pollination of the spring flowers to the point when the fruit is ready for picking. Such costs incurred in growing the fruit before it's ripe can be a good estimate for the fair value of fruit on trees. The only thing the farmer needs to do is make sure these costs are fair and comparable to what other farmers incur before the point of harvest. The tree is like a machine that works for years. It fits the logic of fixed assets and depreciation. At the same time, the apples change and grow during the season, so their value moves with the accumulated cost incurred, with the market expectations of the future selling price and with growth. That fits fair value measurement. That's why, for bearer plants, like our apple trees, we do the following. Account them like fixed assets, cost on day one, then depreciation each year. You can impair them if something goes wrong, for example, a storm, a disease. Revelation model may be allowed, but you, as a beginner, can stick to the cost model. For produce and other biological assets, not bearer plants, we do the following. Measure at fair value less cost to sell at each reporting date, with reference and comparison against the actual accumulated costs, which were incurred from the start of the season to the point of harvest, when you pick apples from the trees. Gains or losses from changes in fair value go to the income statement immediately. At harvest, fair value of the produce less cost to sell becomes the cost of inventory. And compared to the ripening fruit on trees, it also includes the cost of picking the fruit from trees, binning it and moving it from the farm to the storage. After harvest, fruit is just normal inventory, which is measured at lower of cost and net realizable value. Let's run a simple season with our apple trees. We start with planting the orchard, bearer plants. Let's imagine you plant young apple trees for $20,000 plus $2,000 of cost for planting and preparation. Journal entry would be debit bearer plants, PPE $22,000, credit cash $22,000. If the useful life is 20 years, we will get straight line depreciation of $1,100 per year. We ignore residual for simplicity. Then comes the growing season, where we get apples on the trees, our produce. First possible accounting milestone, mid-season. Mid-season, you estimate the apples on the trees. Market prices say the fruit is worth $8,000 and expected selling costs are $500, which means fair value less cost to sell is $7,500. At this point, you have probably incurred approximately the same value in labor, materials, fertilizers and the orchard activities. If you spend more than that, you make a downward fair value adjustment. If you spend less than what the market estimates as fair value, you conservatively value your unripened fruit at the total accumulated costs incurred during this season so far. We started the season with no apples, meaning we had zero in value. Now we have 7,500. This 7,500 are gained and go directly to the income statement. Journal entry would be debit fair value produce in biological assets 7,500, credit income from revaluation surplus 7,500. This step is what the standard says and allows. In reality, a lot of farmers skip such valuation and do that adjustment once a year, and actually even adjust their fiscal years to match their harvesting time, to avoid any unnecessary fair value adjustments in the P&L. So now comes harvest. At harvest, the apple's fair value less cost to sell is 9,000. This becomes the cost of inventory which we are going to sell. Journal entries for this would be debit biological assets 1,500 as an increase compared to the previous value of 7,500, credit income from revaluation surplus 1,500, credit biological assets 9,000, debit inventory 9,000. Full amount of produce is out of biological assets. We are just moving assets around from one class to another, from biological assets to inventory. Now we sell the apples. You sell for $12,000 with 600 selling costs. Income statement shows revenue 12,000, cost of sales uses the 9,000 of inventory cost, selling costs are 600. The ledger bookings will be debit cash 12,000, credit revenue 12,000, credit inventory 9,000, debit COGS 9,000, debit selling cost 600, credit cash 600, assuming we paid for selling costs in cash. And remember, always two sides of a transaction. You see, all our bookings are paired and debits equal credits. In the end of the season and of the year, we record the tree depreciation 1,100 as usual. And the income statement will look like this, excluding all revaluation movements for simplicity. And if the storm damages the orchard, we need to test for the impairment of the trees. Now, as promised, back to fair value. What is actually fair value less cost to sell? It is basically the current market price for similar produce in the same condition, minus the costs to get it sold, like brokerage, market fees, transport to market, distribution charges from large supermarkets, etc. But it excludes income taxes and financing costs. If there is an active market, use that price. If not, use the best available observable inputs and simple valuation techniques. Fair value movements for living produce hit profit as the season progresses. Prices, growth, and risks like weather or disease all move the number. That means the income statement can be more volatile than in a regular trading business. It is normal for agriculture. Imagine, 5 days before the picking time, when all harvesters are ready to go, hail hits and bruises all apples on all trees. Or an army of worms attacks them. What was a fair value of 105 days ago gets impaired to 10. Because all you can do with your apples now is only crush them into juice or cider material. Now let's talk a bit about animals. Animals, such as sheep and cattle, are biological assets measured at fair value less cost to sell. Lambs being born, weight gain, and market price changes create gains and losses through profit. When the animal is born, it has zero value. You invest into it, spend money on food, medicine, etc. And only in a few months, when you can assign value to this animal, you start measuring it at fair value. When you get milk or wool from an animal, this simply becomes inventory and is measured at cost, or net realizable value, if lower than cost. And now, a few common beginner mistakes to avoid. The first one, treating bearer plants like produce. Remember, trees are property, plant and equipment, fixed assets with depreciation. The second one, forgetting to move produce to inventory at harvest. The next one, using selling prices after processing when the standard warrants price for the product in its current condition. And the next one, ignoring cost to sell when measuring fair value. And the last one, not documenting the source of prices and assumptions. Okay, we are through the topic and let's briefly summarize it. Biological assets are living plants and animals. Produce is what you harvest. Bearer plants, apple trees, follow fixed assets rule with depreciation. Produce and other biological assets are at fair value less cost to sell, with gains and losses in profit. At harvest, fair value becomes inventory cost. Expect some earnings volatility. It comes with agriculture. That is biological assets in plain language. Thank you for watching, and if this was interesting and helped, hit like, subscribe and the bell so that you don't miss the next lesson. See you soon.